You can do everything they told you to do, and you can still end up broke. Not because you failed, because the system is designed so the rich get richer while you keep paying the tuition for your own replacement with your time, your rent, and your dignity. This is not financial advice. This is financial education, the kind that makes people angry, because it explains what most people spend their lives pretending not to see, especially in 2026. You are living through a perfect storm. AI is deleting jobs faster than retraining programs can absorb them. Housing prices have detached from wages in the United States, the United Kingdom, Canada, and Australia, so a generation is learning a new skill, renting forever. Inflation may have cooled on paper, but your real purchasing power still hasn't returned to 2019 levels for most households. Meanwhile, the stock market keeps printing highs, as if ordinary people are not drowning. And the scariest part is this: the winners are not just getting lucky, they are building mechanisms. Today I'm going to show you the real loop. How wealth concentrates upward, how institutions manufacture confidence while your life shrinks, how debt gets packaged and sold, and why your attempts to climb feel harder every year. And near the end, I'm going to tell you the only honest call to action that doesn't require wishful thinking. Let's start with a question that feels rude to ask, but it matters more than your feelings. How do you become poor in a world where almost everyone has access to school, careers, and advice? The old answer was simple: don't work hard, don't save, don't invest. But the new answer is harder because it targets your identity. You become poor by following the rules they wrote for someone else's benefit. Imagine a person named David. He is 32. He works nights at a hospital in Ohio because nurses always need nurses, right? David did the right things. He took student loans, he finished school, he picked a stable career, he even moved into a cheaper apartment because the rent jumped again. Then DI starts showing up in his workplace. Not as a robot replacing him overnight, but as software that schedules patients with fewer staff hours, reduces paperwork, automates billing, and uses cheaper staffing models. David still works, but his workload changes. He gets new targets. He gets less bargaining power. His manager says it's efficiency. Now picture the same David trying to catch up financially. In 2021, the rent in his area spiked. In 2022 and 2023, he watched prices rise again and again. By 2024, headlines said inflation was back under control, but David's paycheck did magically start buying more. According to Federal Reserve data, real median household income has not caught up to the loss in purchasing power since the inflation surge began in 2021. So when David asks his landlord for relief, he gets a polite answer: market rates. And here is the part nobody wants to say out loud: David's poverty doesn't come from laziness, it comes from a transfer mechanism. His rent payments go to a property owner, which may be an individual, but increasingly it is a financial institution with huge portfolios. That institution invests those cash flows, and those investments can be supported by cheap funding when the Fed cuts rates, or by special liquidity when the system panics. When the economy moves, David moves with it downward. You might be thinking, okay, but that is just one person, one story, not a blueprint. So let's zoom out and talk about the concentration problem. In the United States, the United Kingdom, and across most developed economies, wealth inequality has continued to widen. The top 1% owns a larger share than it did in prior decades, and the bottom majority absorbs the costs: higher living expenses, weaker job security, and long-term underfunding of retirement systems. When people say the rich are getting richer, they sound like cartoon villains. But look at the mechanics and you'll stop needing cartoons. There is a reason the richest actors do not chase money the way you do. You chase a paycheck, they chase control. And control is built with ownership. In 2026, the biggest owners of major public companies are not always the founders. They are often asset managers. Two names keep showing up in the background of everything from tech to energy to healthcare: Vanguard and BlackRock. These firms manage enormous pools of capital, and because they are everywhere, they become the silent middle layer between you and the companies you depend on. You've probably heard a version of this story before, but here is why it matters now. In the era of AI and global rate shifts, capital doesn't just move faster. It also moves with more coordination. When large asset managers hold major stakes across many industries, their influence doesn't stay inside one company. It shapes how the entire market reacts. And this is where your life gets uncomfortable. Because if the market is shaped by a few dominant owners, then your belief that you are choosing between brands is a comforting illusion. You are choosing products, yes, but you are not choosing the owners who decide how profits are extracted, how executive incentives are designed, how share buybacks are timed, and how risk is distributed. Now let's tie this into the biggest 2026 reality. AI is accelerating efficiency and shrinking headcount. The old Learn to code, and you'll be safe. Advice from the early AI boom was propaganda for the version of the future that benefited investors. AI can write software. It can automate spreadsheets. It can draft marketing campaigns, analyze documents, and perform parts of legal work. Even if humans stay in the workflow, fewer humans are needed. So what happens to workers when fewer workers are required? Wages don't automatically rise. Employers negotiate harder. People accept lower terms because they are afraid of unemployment. Meanwhile, firms that own the machines, the data, the infrastructure, and the capital have fewer operational bottlenecks. Their profits become less about labor and more about asset ownership. But you still need a place to live. That brings us to housing, the part where hope dies. In the United States and the UK and Canada, housing prices have detached from wages so badly that even people with solid jobs feel trapped. In many areas, the monthly payment for a typical home now represents years of salary growth, not a manageable stretch, and that does something to a society. It turns adulthood into a long lease. Picture another person. Her name is Maya. She is 29. She works remotely for a company that promised job security. She doesn't live in a mansion. She lives in a small apartment because mortgages are out of reach. She keeps hearing that rates might fall, that things could normalize, so she waits. Then the Fed holds rates higher than people expected, trying to tame inflation. Official inflation might cool from its peak, but mortgage affordability doesn't care about a headline. It cares about the interest rate, the price of the home, and your income. If the Fed cuts too slowly, your ability to buy doesn't improve. If the Fed cuts too fast, inflation worries return and lenders tighten anyway. So Maya waits. She saves. She invests a little, but every year rent goes up, and when rent rises, she saves less. When she saves less, she falls further behind. This is not personal failure. It is arithmetic. Now connect this with the wealth concentration mechanism. When more people are stuck renting, more cash flows to landlords and the institutions behind them. Those cash flows can be invested into financial markets, and when financial markets rise, owners get wealth growth, while renters get inflation exposure. That asymmetry is the whole game. But it gets darker. Because once you understand that debt and ownership are intertwined, you start seeing the real role of the Fed, not in ideology, but in outcomes. The Federal Reserve sets interest rates and influences liquidity conditions. When rates are higher, borrowing costs rise. When rates are lower, borrowing becomes easier. But here is the uncomfortable truth. The effect of rate changes is not evenly distributed. Households with variable rate debt and high rent burdens feel it immediately. Large institutions feel it through funding markets and investment strategies, and they can often reposition faster than you can. And during crises, the Fed doesn't merely stabilize. It creates survival corridors for the system's capital stack. That can mean liquidity facilities, asset purchases, or emergency programs designed to keep credit flowing. The intention might be broad stability, but the structure funnels benefits through financial intermediaries that already have the ability to access markets. In 2023, when Silicon Valley Bank failed, the world watched depositors panic and clients scramble. But the structure mattered. Some institutions were able to absorb losses, while others were protected through emergency mechanisms. Asset managers and large financial firms gained opportunities to buy distressed assets. That is how wealth accelerates during fear. And if you think that is just how markets work, you should ask why the same pattern repeats. Fear happens. Assets get cheap. Institutions with cash and access buy. Then markets recover. Institutions profit. And retail investors, the people who actually suffered the panic, often buy back later after the worst is over, which means they buy higher. Now here is where the story gets truly ugly. Debt is the universal bridge between your paycheck and their control. You might think debt is personal, like a student loan, a credit card, or a mortgage, but at the institutional level, debt is turned into a tradable product. It becomes an asset class. Let me explain it in plain language with a micro story. Suppose you buy a house and you borrow money, you sign a loan. If you pay, you get a home. If you fail to pay, the lender can take collateral. That sounds straightforward, but the lender does not want to hold the risk for 30 years. Holding debt means tying up capital. So what do? They package the debt into securities and sell it. Now someone else owns the right to collect payments. That someone else might be a pension fund, an insurance company, or a large asset manager. The original bank gets cash immediately. The risk has been transferred. But the real power lives with whoever controls the flow of cash when payments stop. In the subprime mortgage crisis of 2008, this machinery broke in a catastrophic way. Loans to borrowers who could not reliably repay were bundled, rated as safer than they were, and sold widely. When house prices fell, defaults rose, and the securities collapsed. That created real harm for millions of families.
But the crisis also created an acquisition opportunity for firms that had liquidity, political connections, and the ability to buy distressed assets at scale. After the crash, some of the strongest players picked up major institutions cheaply. Now bring it to 2026, the same pattern evolves. Instead of subprime mortgages, it can be commercial real estate, corporate credit, or private lending structures.
Instead of one type of asset, it is whatever sector currently looks profitable to extract from under stress. The names change. The mechanism doesn't. And the big players do not just buy assets. They influence policy decisions that determine which assets survive. This is where you need to understand a 2026 reality most people ignore. Policy is not made by the public. It is made by networks. Officials rotate between regulatory roles and industry positions. Think about the incentive structure. When people move through the same circles, they learn what outcomes are rewarded. That is why you can watch a collapse occur and still see big firms protected, rescued, or positioned to benefit. Now you might ask, if the system is rigged, why does the stock market still climb? Why do headlines keep talking about record highs? Because the market is not designed to maximize your comfort. It is designed to allocate capital under rules set by institutions. When governments stabilize the financial system and liquidity is available, markets can rally even while workers struggle. That is not a contradiction. It is how financial markets work. Also, in 2026, AI itself changes market behavior. Algorithmic trading can react to news in milliseconds. Options markets can amplify volatility. Index funds can push flows regardless of fundamentals. And when large asset managers hold major stakes, their coordinated engagement with companies shapes corporate behavior. But there is another reason. The system manufactures confidence. When interest rates are managed, when liquidity is introduced, and when media coverage emphasizes stability, retail investors often interpret that as a sign that everything is fine. They pour money into the rally. Some will win. Many will lose when the cycle turns. Meanwhile, large players can use the rally to reposition, hedge, and exit. Now ask yourself something. In the last few years, how many times did small investors get burned right after feeling safe? You didn't just lose money, you were trained. You were conditioned to chase momentum, to believe narratives, to ignore risk, and to confuse asset price with personal prosperity. So let's talk about the biggest illusion of all, passive income and financial freedom. On social media, everyone sells a fantasy. They show spreadsheets, they show luxury lifestyles. They say you can be free if you learn one simple trick. But most creators earn almost nothing from their own advice. Many make money from the audience through advertising revenue, sponsorships, affiliate commissions, and course funnels. The financial freedom being sold is not yours. And even when a real person does build income streams, the broader macro environment can still destroy them. A creator can have a profitable channel and still face inflation. A landlord can have stable income and still suffer if insurance collapses due to climate-driven disasters. A retiree can have assets and still feel broke because healthcare costs rise faster than returns. In 2026, climate disruptions have turned insurance into an economic weapon. In multiple U.S. states, insurance availability has tightened, premiums have risen, some homeowners cannot get coverage at reasonable prices, which creates forced sales or expensive reinsurance structures. That pushes wealth away from households and toward whoever controls capital and risk modeling. So while you were watching passive income fantasies, the real world was shifting underneath you. Your insurance might renew at a higher rate. Your property taxes might rise, your rent might increase, your employer might cut hours, and your retirement system might be underfunded while the retirement age keeps getting pushed back. Social Security, in many projections, is under stress due to demographics. Aging populations increase spending needs while fewer workers support the system. Even if politicians delay the decision, the arithmetic doesn't disappear. Pensions have funding gaps. Some corporate plans were underfunded after market swings. You can delay your retirement, but you cannot delay reality forever. And this brings us to the most brutal question of 2026. Who benefits when you are forced to work longer? Not you, because the longer you work, the longer you delay your escape from wage dependence. If the rules push retirement later, then your income continues feeding the economy and the tax base for longer. Meanwhile, those with capital can compound wealth over a longer horizon without needing to sell labor. So here's the darker understanding you need to hold in your mind. The system doesn't merely punish failure, it punishes waiting. It rewards speed, it rewards access, it rewards ownership and leverage. If you are always reacting, always trying to catch up, always one bill away from trouble, you are playing their game. Now we need to talk about the 3 tricks that keep you trapped because they are not random, they are engineered. Trick 1 is converting necessities into expensive symbols. You need love, belonging, security, and status. The market sells you substitutes, it sells you expensive proof. There is a reason luxury brands are always selling to couples, to parents, to aspirational people. It isn't just about taste, it is about hierarchy. If you can be convinced that a meaningful relationship requires a high-priced object, you will spend money that you do not have, and you will feel guilty for not spending enough. A diamond is a perfect example because it is turned into a life script. You are told to buy it to prove commitment. You are told it will hold value, but historically, most luxury goods lose value after purchase. The value is not economic, it is psychological. Trick 2 is using social comparison as a tax. If you believe that price signals worth, you will chase spending to keep your identity intact.
You will buy the right bag, the right car, the right phone, the right watch, the right furniture package. You will do it even when you don't like the product, because you like the feeling of not being excluded. In 2026, the comparison mechanism is even more brutal because social media makes status visible all day. You do not just see people who are doing well, you see the moments when they show off the upgrades, the vacations, the new device, the new deal, and you absorb it like a slow poison. Trick 3 is planned discontent, the endless cycle of newness. Your stuff becomes old, not because it breaks, but because a newer version exists, and the marketing tells you are falling behind. When your identity is anchored to consumption, you never reach stability. You keep upgrading, which keeps you tied to monthly payments. And that is why installment plans matter more than people admit. In your 20s and 30s, you might think financing is just convenience. But in aggregate, it is labor replacement. It turns future income into present spending. It locks your household cash flow into a schedule controlled by lenders and retailers.